Good evening and welcome to this month's edition of the Monthly Market Equity Insight. And as usual, I have one of my colleagues joining me on the call this month. We have Amit Premchandani, who manages the UTI Value Opportunities Fund. He's been with UTI for coming up to almost 15 plus years now. And he's been a fund manager with the value opportunity strategy for nearly 5 years, has a wealth of experience as a banking and financial services analyst for many years, also looked at the cement sector and the telecom sector. So wide range of experience as an analyst before going on to become a fund manager. And he's going to be talking about the UTI Value Opportunities Fund today. So the way we'll do this, as always, is I'll kick off with a overwrap of what's been happening in the markets. Where do we stand in terms of earnings? Where do we stand in terms of valuations? And thanks to all of our regular viewers, we already have a bunch of questions which have come through. So we'll cover some of those questions as part of the initial conversation. And after that, the live questions that keep coming in at Ask UTI, we'll take up those questions as well, depending on the time and extent that we are able to cover. So without any further ado, we'll get underway with this April edition of the Market Insight Equity. So first off the bat, many of you who have been in the markets for a long period of time would be aware of the global financial crisis, and you would also be aware of how the panic spread through the financial system and then eventually affected both stock markets and eventually the economies as well. This was during the period 2008-2009. Now, the reason I refer back to the global financial crisis is last month we had some events in the banking system, particularly in the US and then also in Europe, which sent tremors through the financial system. It exposed some of the fragilities within the financial system, and this caused people to start worrying about, does this feel like the global financial crisis of 2008, 2009 all over again? So what I'm going to do over the next 4 or 5 slides is essentially look at how was India positioned during the period leading up to the global financial crisis, and how does it compare to where India is positioned today in the run-up to this recent tiny tremor that we've experienced in both Europe as well as in America. Very little of those tremors actually reaching our shores at this point of time. So what you can see on this slide is the behavior of real GDP in the run-up to the global financial crisis of 8-9, and even extending slightly beyond to 2011. That's on the right-hand side of the slide to the left of the dotted line. And as you can see, India was growing very rapidly heading into the global financial crisis. And in fact, except for 1 year, where growth slowed, which was the year ended March 09, growth in fact accelerated the next 2 years. So when you look at the entire period from 04 to 2011, including the period of the setback in 2009, the CAGR of GDP growth was almost 7.3%. So essentially, we went in very, very hot in terms of growth into the crisis. And except for 1 year, which was 2009, we emerged again on the other side with a fairly rapid period of growth. However, when you look at the run-up to March 23, you will see over here that the CAGR of growth is much, much slower. Now, this is not to say that the two periods are comparable, because obviously, the previous period did not have a pandemic, which caused people to sit at home. But the simple fact is growth in India over the last 4 or 5 years is been very, very slow because of the pandemic. So unlike the global financial crisis, where India was a car which was traveling at a very fast pace, and then suddenly you're forced to jam on the brakes, this time around, the economy is going in much cooler because the growth rate itself is much slower. And to that extent, therefore, in some senses, there is a much higher degree of maneuverability, and you don't have to slam on the brakes as hard as it happened during the GFC. So this is as far as GDP growth is concerned. But let's move on to the next slide to look at some of the other indicators. So moving on to the next slide. So here we are just looking at the behavior of the repo rate during the period of the GFC, in the run-up to the GFC, and the recent behavior of rates in India. So on the left-hand side is the repo rate, GFC and current, the blue line being the repo rate during the period leading up to the GFC and then after, and the black line represents the current period. Now, one of the things you will notice here is that during the period where growth was accelerating, during the period 2004, 2008, the repo rate was continuously going up, but it did not halt the economy because, in fact, it was the movement in growth which was causing rates to go up. But because growth was so strong, the economy was able to absorb the increase in rates. But then when the GFC hits, the macro environment turns very dramatically, and policymakers orchestrate a dramatic decline in rates over a very, very short period of time. And you can see in that brief period of time, rates go from 9% to under 5%. So almost 450 basis points of rate cuts literally happening in the period of a year. This time around, of course, we yet to see any cut in rates, but unusually what we've seen is a very sharp increase in rates. In fact, the effective policy rates have gone up more than 300 basis points over a 12-month period, which is much more rapid than anything we experienced in 2008 or 2007. On the right side, you have inflation. Again, the blue line is inflation during the GFC period. The black line is the recent trend in inflation. And this counts back to the current point in time. And as you can see, inflation during that period actually went much, much higher than the recent peak in inflation. So there are two things we must keep in mind which are very different. The inflation that happened during the 2000 era was led by very strong demand, not by supply side shocks, whereas the recent increase in inflation is led more by supply side shocks than it is by very strong demand. Second thing which is very different is that today India's monetary policy is determined by the MPC, which has an inflation targeting mandate of 4 plus or minus 2%, whereas in the previous era leading up to the GFC, there was no MPC, there was no such mandate, and therefore, in a sense, policy making was continuously shifting between either trying to cap inflation or trying to support growth. Today, the policy dimensions are far more operating in a far more narrow range. And that's why the inflation trajectory looks very different. And we are unlikely to see the kind of spike that was witnessed at that point of time. We move on to the next slide. And here we are looking at the capex cycle. Now, again, the period of the pre-GFC era was a period of extremely strong gross capital formation, fixed capital formation within the economy. On the left-hand side, you can see those bars, and capital formation was running at 20% to 35% for a period of time. Then you, of course, see that one bar in 2009 on the left-hand side where growth slows because of the GFC, and then the next 2 years, once again, it accelerates. In fact, growth in terms of the capex cycle, we all know has been very weak in India for almost a decade. But what makes things slightly different is that this time around, we are exiting a period of low growth. So in a sense, March 22, which is the first good year we have seen in terms of capex, unlike what we saw the previous time where the GFC hit when you had seen many years of strong capital formation take place in the economy. So what is very different is that this time around, operating cash flow growth is much stronger than capital formation. And therefore, in a sense, the economy is better placed to fund capex, which you can see on the right-hand side, that improvement in operating cash generation exceeds capex this time around by a wide margin. So in a sense, it does provide some support to capex, though not necessarily the animal spirits. Moving on to the next slide. This again captures another dimension of capex. For a strong capex cycle to play out, you need the financial system to be a partner of the growth by providing money to businesses and sectors which wish to grow. And that can only happen when banks feel comfortable about their current situation in terms of their balance sheet strength. Rightly or wrongly, but it's their situation at that point in time which determines their willingness to lend. And as you can see over there, at going into the GFC, the bank balance sheets, at least as they were reported, had very low NPAs. Now, we do know that the banks did not report NPAs for many years, and it was only in 2015 when RBI implemented what they call the asset quality test regime that the banks started to report the NPAs, and we see that huge surge. But the good news is that today's situation in terms of NPAs have continued to decline. Today, the bank NPAs are actually closer on a net basis to where we were in 2005 or 2006, which means that the banks have a lot more appetite to lend. On the right-hand side, you can see the credit growth pattern. Now, obviously, the pre-GFC era was very, very different. There were years in which credit was consistently growing at 30 to 35%. So it was growing more than 2x GDP. In recent years, we have not experienced that kind of credit growth. It's been much more moderate at maybe slightly over GDP growth to 1.2 times GDP growth. And therefore, the whole trajectory of the black line, which represents current credit growth, is much lower than the blue line, which represents credit growth during the GFC era. And again, this gives some comfort that the banks still have the ability, both in terms of not having the system having overheated, and also in terms of strong balance sheets, in terms of therefore their willingness to lend and support capex. So we're in a slightly more supportive position today than we were when the GFC actually hit. So that was a wrap of how some of the parameters look compared to the GFC era. We'll now quickly move on to the section where we talk about earnings, valuation, and also talk about some of the macro trends that we are seeing today. As far as equity valuations are concerned, if you're a regular viewer of our monthly equity insight, you would be very familiar with this particular slide. And this shows you the growth in EPS over a very long trajectory. And the last three bars, rather the last two bars, show you the expectations for March 23, which is yet to be reported, and also the expectations for March 24. Now, note over here that there is now been a significant earnings compression for March 23, where the earnings number is now forecast just at 5% growth in March 23, but still a very aggressive growth estimate for March 24 of nearly 23% in consensus earnings. The next slide will make it more interesting, because if you notice over here, there are two trends which become visible. One, while the earnings for FY23 are continuously being cut, the earnings for FY24 have more or less flatlined over the past 6 months. So as a result of that, I do think there is some risk to the FY24 earnings growth, because that number being unchanged means that the implied growth has gone up to almost 20% plus, and that looks a little difficult, but we'll talk about it at more length later. So jumping on to the next slide, and here we talk about valuations. On the left-hand side, you have the valuations of the large cap part of the market, which is the Nifty 50. And on the right side, you have the valuations of the same Nifty 50, except this is a forward PE multiple rather than a trailing PE multiple. But the message from both is largely similar. The yellow line that you see in the middle, horizontal line, is the long-term average. There was a period of time in 21 and 22 when the markets were trading above the long-term average. In fact, they were trading above the red line, which pretty much puts it one standard deviation above the long-term average, making it unattractive for equities. As you know, now for 18 months, markets have more or less gone nowhere. And therefore, as a result, in PE terms, the market has actually become cheaper. In fact, I think we can now safely say that the equity markets have come back within the comfort zone, still above the long-term average, but certainly within the comfort zone, whether you look at trailing PE multiple or at forward PE multiple. If we move to the next slide, here we are looking at the left-hand side, which is the price to book multiple. And on the right side, we are looking at the return on equity. Now, I will actually look at the return on equity slide first, because I think what is very remarkable here is that the Nifty 50 return on equity is actually the best return we have had in return on equity in almost about 7 or 8 years. And that is one reason why today on a price to book basis, the Nifty is trading somewhere between the long-term average and the expensive zone. But I must say that given the high ROE, again, the message, if you want to call it that, that we are getting from the price to book ratio is that the markets are now trading more within the comfort zone. What do we define as comfort zone? The area of valuations between the green line and the red line is the fairly valued zone. And in that zone, we broadly call it the comfort zone. So you're no longer expensive the way you used to be about 18 months ago. What about mid caps and small caps? That's coming up on the next slide. And you can see over here, there's some amount of change of year related phenomenon in the price to book measures. But I think it's now safe to say that the mid-cap price to book is very clearly in the comfort zone. And even the small cap price to book, which I would have said almost for the last 12 to 15 months has remained expensive, has finally started to cool off and come back within the comfort zone. Our preference would still be large over mid and mid over small, but no longer blinking as aggressively red on the price to book as it used to earlier. Though when I look at the PE, I'm still a little bit tactically concerned on small caps and mid caps, because in an environment where rates are high, these companies, because their access to capital is typically slightly more challenged under such circumstances, tend to perhaps feel the pressure more than their large cap brethren, who typically tend to have much stronger balance sheets. So the order of preference still large over mid over small, but certainly mid caps and small caps no longer blinking red as they were till quite recently. Moving on to the next slide. This presents the picture of equities versus bonds. Now, all of you would be familiar that for some time we've been saying that there are reasonable alternatives. It is no longer a case of TINA, because bonds are giving you a reasonable real return compared to inflation trajectory at this point of time. And what we are doing on this slide is comparing the earnings yield of the Nifty 50, which is nothing but 100 divided by the forward PE multiple of the Nifty, and comparing it to the 10-year GSEC yield. Now, this indicator had moved to minus 200 basis points, which is very favorable for fixed income. The long-term differential is 100 basis points. But as you can see, that blue line is now gradually climbing back. And if it were to get closer to that yellow line, I think very clearly equities would, be sort of the preferred asset class. But we are not there as yet. It's still sort of halfway to the yellow line. So again, we would say slightly favorable yet for fixed income, but not as adverse as it was 6 months ago from a tactical point of view. Moving on to the next slide. This is sort of the large cap versus mid cap. Now, mid caps are most attractive when that line is in the gray territory. When it is in the green territory, it means that the Nifty 50 is at a discount to the mid cap, and which is why I said on an earnings basis, I would still tend to say large over mid and mid over small, and maybe the gap between large and mid is slightly smaller than it had sort of expanded to earlier. But the message from here just sort of reiterates what I said earlier. So finally, just to move on to our sort of summary slide, there is no doubt with the banking crisis that happened with Silicon Valley Bank in the month of March in the US, the expectations of the extent to which the US Federal Reserve will be able to take up rates has kind of come down dramatically. Now the expectation is that the maximum rate could be 5.25% as opposed to the expectation of 5.5% earlier. And also the market is now a lot more believing of the fact that there will be rate cuts by December, though the Federal Reserve still says they don't see a possibility of rate cuts during the current year. The reason they do not see possibility of rate cut is in the second line that you see over there. The Federal Reserve continues to believe that next year's inflation, their preferred inflation measure is called the PCE. They believe the central tendency of that number will be 2.2 to 2.8%. Their stated target for inflation is 2%. So if the expectation is that inflation will remain well above their target, it means that in some senses they will have to remain in pause mode or at least in restrictive territory to ensure that inflation cools down to 2%. Now, there is increasingly a school of thought that eventually the US Fed may abandon the 2% target. But at this point of time, at least the US Federal Reserve Chairman insists that they will not abandon the target. And that being the case, a pause seems to be the more likely outcome in terms of rates. Commodity prices have fully given back the gains of 2022, the Russia-Ukraine conflict-related spike in commodity prices. Those have completely unwound. But US inflation is still witnessing pressures. Why is it witnessing pressures? There are two sources. One, a very tight labor market. They have a short supply of labor. For every one person who wants a job, two jobs were available to till some months ago. Even now that number is running at around 1.7 to 1.8. So it's still a tight labor market, and that is driving services inflation. The other underlying cause of inflation pressure is the housing market. So these two will take some time for inflation to correct back because their inflation is not goods related, which is more commodity price related. It is more related to labor and housing. In India, of course, our inflation number is more linked to goods than it is to housing. And the MPC has now hit the pause button on rate hikes. And it is, retained its policy stance as withdrawal of accommodation. It was an unexpected move when they hit the pause button on rates. But they also indicated that this should be treated as a pause and not as a pivot because they are still waiting to see what the implication of the aggressive rate hikes that they did. Remember, I mentioned 300 plus basis points of effective policy action. They want to see what the impact of that will be on the economy and growth before they do anything further. Having said all of that, this is why I believe there is some risk to earnings estimates in 24. Can earnings really grow at 20% plus when you have a global economy that is slowing, when you have India also, which is sort of on stable to slowing territory, you've got monetary restraint all over the world, and you've got a weak global environment. So that makes a 20% earnings growth outcome not impossible, but statistically, I would say there is some risk to those numbers, and which is why we think one should be cautious about those forward estimates at this point. Equity valuations, good news. Prices going nowhere for 18 months. Effectively, they have derated, though they are still above the long-term average. Bonds appear slightly favorable relative to equities at this point of time. Our recommendation to investors is that they should adopt a staggered approach. So that sort of sums up what we believe is, a roundup of the entire market at this point of time. I'll, of course, come back once again to take and address your questions. But what I'm going to do now is hand over to Amit. As I said, Amit manages the Value Opportunities Strategy, which is a value fund as per the SEBI categorization. And this is a fund he co-managed with me for a long period of time before taking sole charge of it. And, he's now going to describe to you the strategy and how the portfolio is currently positioned. Over to you, Amit.
Good evening, everyone. Thanks, Vetri. I will speak about the UTI Value Opportunity Fund. As you are aware, it's an open-ended equity scheme which follows intrinsic value strategy instead of the traditional multiple-based definition of value. The fund has a very flexible approach in terms of investing across market cap based on available opportunities. Some of the levers that we used to manage the fund are primarily the number one lever is to apply valuation filter for sectoral allocation. The valuation filter approach is largely driven by valuation consideration. In case of cyclical sectors, we focus on asset-based matrices or book value matrices, which actually work as a better guide as far as valuation is concerned. This is because earning-based matrices can be misleading in cyclical sectors, especially during market turns or cyclical turns in sectors. For example, in cyclical sectors such as metal, banks, or cement, we use the metrics like price to book or EV per ton, which are asset-based matrices, as compared to earning-based matrices like EV EBITDA or PE, which tend to be cheap during market peaks or during earning peak, and expensive and look expensive during the cycle troughs. We use earning-based matrices for taking valuation calls in sectors which have stable characters like staple, IT, or pharma. Here, we primarily used implied growth comparison and compare it with the delivered growth on a long-term basis in that sector and see where we are in terms of what market is pricing as an implied growth. For example, IT is one sector where we have used this approach both in 2018 when the sector had very strong cash flow profile, but the implied growth in terms of valuation was in low single digit. And the same approach was used on the reverse side in late 2021 when the entire sector got re-rated on the back of significant growth coming out of COVID. The implied growth moved from, say, single digit in 2018, mid-single digit, to mid-teens in 2021. And we used both part of the valuation cycle to either increase our exposure or reduce our exposure. Even in 2023, we have started now, as the valuation of, say, IT as a sector has corrected, and implied growth in most of the large cap are in mid to high single digit, we have started adding back exposure because the free cash flow profile of this sector is pretty strong. And even in a subdued year of FY23, the sector is reporting better free cash flow growth as compared to some of the consumer-oriented sector. Just to give you a sense of how we use a valuation call, is to just focus on how customers buy during the end of sales season as compared to going to a mall during full price season. So typically we think that during the end of sales season, you get the same brands available at 30 to 40% discount as compared to the MRP, and most of the products are only having a 6-month-old production cycle, so they are still in fashion. Same approach is used by us in terms of taking buying decision during tough times. The only difference is that during the end of sales season, you see a lot of crowd and you have to be choosier. But when the same season is available in the market, actually you don't encounter any crowd because the momentum is against that sector. So typically we use this approach in cyclical sectors where short-term factors can negatively impact cash flow over 1 to 1.5 years, but are unlikely to impact the long-term growth runway of that sector, or the balance sheet of the companies operating in the sector are stable. So key is to manage the balance sheet risk. And the same inverse analogy is used while trimming exposure based on sectoral valuation. The second lever that we used as far as stock selection is concerned is the barbell approach. Here we use kind of the analogy of a barbell, which is an exercise equipment which has weight attached to both end of the bar. In the Value Opportunity Fund, will apply this concept by investing in companies with the same to keep the same sense of balance of growth as well as cyclical stocks. So on one hand, we invest in firms which are going through cyclical downturns, but have no limited or very limited terminal value risk. While the market is actually excessively focused on the current downturn, ignoring the potential turnaround capabilities of or the cyclical nature of the business. So we invest in cyclical companies with very low terminal value risk. At the same time, on the other hand, we focus on stocks which have a high growth potential, a long runway for growth, and having a very strong franchise, but are not very but which are underappreciated and not overly expensive. In both these situations, we are trying to buy something which is relatively cheap relative to the expectation. Our philosophy has been to avoid taking balance sheet risk both at a sector level as well as following the barbell approach. But we are very comfortable taking P&L risk, which especially is unavoidable in case of cyclical sectors. On the growth side of the bubble, we try to avoid taking stocks or taking exposure to stocks which are building a very high implied growth in their valuation. In real life, again, you can compare this barbell approach to picking up someone like Virat Kohli on the growth side of the barbell, where he plays or he's expected to play well both in all forms of the cricket, whether it is Test, One Day, or IPL. And on the other hand, you in terms of cyclical stocks, you try to pick someone like Surya Kumar Yadav, who may not be suitable for all three forms of cricket, but he does really well in the T20 version, and he can hence he can do very he can do very well during specific formats or specific cyclical when the cycle is in the favor. So just to visualize, this is how we approach the barbell strategy. The third lever that we use is actually the allocation across market cap. This is used quite sparingly. This is how we allocate between mid, small, and large cap. We have been using this lever, and the allocation range of the mid and small cap has moved between 18 to 35% over the last 5 years. Currently, that exposure is to small and mid cap is around 30%. We believe such changes work more in small cap rather than mid cap, which generally have demonstrated relatively stable outcomes. If you go to the next slide, in terms of how we use this intrinsic value approach in practice, we actually use this approach through guardrails and applying margin of safety concepts. We have a set of guiding principles which we use to bring about consistency in approach as well as bring stability. For example, we focus on companies which have relatively high return on capital over the cycle. For example, if you look at cement sector, Shree Cement is a company which has high ROC profile across the cycle as compared to the peers in the sector. So we prefer such kind of stocks in cement sector. We are not averse to invest in companies which are going through weak operating cycles, provided these operating cycle, we catch that operating cycle at the bottom. For example, we have invested in hotel stocks and it actually increased our exposure during the COVID period because some of the hotel companies were going through cyclical pressure, and we are aware that once everything opens up, the operating leverage of the hotels as a sector will ensure that the profitability of that sector of the company will kind of go up disproportionately. But again, we have to be very wary about balance sheet risk while buying such weak operating companies. We also look at option values which are inherent in the company that we buy. For example, in SBI or ICICI Bank, when we bought the stocks, they were trading at decadal low valuation. However, we were also quite comfortable buying these stocks because both these companies are invested in subsidiaries which were profitable, and market was not giving value or focusing on these subsidiaries during turbulent times. And these subsidiaries created a lot of option value when they required capital, when they had to provide for losses after the AQR. Also, the valuation metrics, we use free cash flow yield to compare across sectors as well as across stocks, as compared to the traditional PE ratios. And we have used that approach to invest in IT sector as well as the healthcare sector over the consumer sector, given that free cash flow yields are better in IT, especially as compared to the consumer sectors with similar growth profile. On the avoid side of intrinsic value, we generally avoid stocks which have or sectors which have high terminal value risk. For example, we have avoided media or traditional media companies, despite them having a very high free cash flow yield, because of the inherent shift from traditional broadcasting to OTT. Or we have also avoided investing in many resource-based companies which are catering to old economy sectors, but have to face the risk of technology obsolescence because of either the entire world moving from thermal power to renewable power, or the world kind of deciding that coal as a fuel cannot be used at least on an incremental basis. So we try to avoid these terminal risks. Also, we avoid investing in stressed balance sheet companies. For example, in the construction sector, we have exited exposure despite cheap valuation, largely because of the fact that working capital of that company continued to move up and margin profile went down because the company was focused more on getting orders rather than improving margins. And hence, we kind of completely exited the stock because at the end of the day, if balance sheet is kind of damaged, we are not really sure whether there's a terminal value, there's a terminal risk in that company. So using these three core levers, the overall portfolio valuation is end up being much cheaper than the benchmark. And on an aggregate basis, we look at price to book as a valuation metrics, and we are generally significantly cheaper than the benchmark on a price to book basis at a portfolio valuation. Currently, we are at 30% discount to the benchmark. We use price to book for judging our value approach because it is a less volatile measure, and if we invest in cyclically challenged companies, they tend to have much more volatile earnings, which can kind of impact the PE or the EV/EBITDA or earning driven measures of the portfolio, while price to book is a much more stable measure. Also, adding to our conviction driven approach, we generally do not have any non-zero exposure to stocks. We either have a non-zero underweight exposure to the stocks. We either have a overweight position as compared to the benchmark, or we have zero allocation to the company. This again is getting reflected in the high active share that we have in the portfolio, which have been consistently followed over the last few years. So if you look at next slide, please. Next. So here you look at the valuation of, again, use of that sectoral allocation approach, where IT sector valuation is driving our sectoral allocation. In the next slide, you will look at the how we have applied barbell strategy in practice. Next slide, please. So here, IT as a sector, you will see that we have invested at both ends of the barbell, with Tech Mahindra on the value side of the barbell and L&T Infotech on the growth side of the barbell. Here we decide on which side the stock is based on traditional valuation approaches of the sector, where free cash flow yield, say of Tech Mahindra, is as high at 6%, while L&T Infotech free cash flow yield could be 3 to 4%. Similarly, in FMCG, we use this barbell approach in investing in ITC as well as Marico, where ITC before this current rally was trading at a significant discount to the entire FMCG pack. Although it was reporting decent growth, market was concerned about the cash flow growth profile of that company because of the large tobacco related cash flows that the company was generating. Next, if you just look at banking and financial services, we had invested both in HDFC Bank and ICICI Bank, which are on the both end of the while their HDFC Bank was at the growth end of the barbell, delivering stable 20% kind of growth consistently over decades, while ICICI Bank at the time of investment was going through cyclical pressures arising out of asset quality review. So we had invested at both ends of the barbell. It's a different matter that the valuations have converged, given that ICICI Bank has got significantly re-rated. In the auto, we had invested at both ends of the barbell through both the two-wheelers name, Eicher, which is a premiumization story, catering to 250cc and above market, which is a long-term growth market, while Bajaj Auto was a cyclical value play, which has very high dividend yield and almost 50% of revenue coming from the overseas market. So these are just few of the examples of we applying the concept of barbell at a stock level in practice. The sectoral movement over the last, say, 1 year has largely been driven by valuation. So we have increased our exposure to the automobile sector over the last 1 year. There have been changes in the portfolio mix in terms of stocks. We have added passenger vehicle as a sub-segment in the automobile sector and reduced the auto ancillary as a sub-segment in the automobile sector. This is again driven by our expectation of passenger vehicle volume likely to see an uptick and margins also coming out of the bottom in both two-wheelers as well as the passenger vehicle segment. While we have reduced exposure to capital goods sector, given that valuation of that sector or some of the companies in that sector had reached one standard deviation, and the implied growth of some of the stocks that we held had reached significantly higher than what the companies have delivered over the last decade. We have also reduced exposure to FMCG in the last 1 year, again driven by the fact that one of the stocks that we used to own had re-rated significantly over the last 1 year, and since we have an approach of either having a overweight exposure to the stock or zero, we kind of actually completely exited that stock. BFSI is another sector where valuation were comfortable 1 year back, and we consistently increased our exposure over the last 1 year. Of late, we have been holding on to that exposure or maybe booking some profits in some of the large cap names we had. That is largely to do with very high active share in some of the names, and we just wanted to trim that active share. IT is an interesting case that we completely went underweight in 2021 or early 2022 when valuation was very high. Implied growth was around 15% for the sector per se, and every stock in that sector rallied. And we kind of have an approach of using that valuation filter, and we reduced that exposure significantly. While of late, we have increased our exposure in IT sector, given that the free cash flow profile of that sector has not changed, and the earning growth of that sector has been even now in low double digits. And curiously, after the Q3 numbers, this was one of the few sectors which saw earning upgrades. It's another matter that the banking crisis has hit us in March, which will start reflecting maybe in the earning estimate numbers after the Q4 numbers. But nevertheless, we have used our valuation-driven approach, and when the implied growth of that sector moved below double digits to kind of 8 to 9, depending on the company, we have increased our exposure to that sector. Another sector where we have sharply increased our exposure has been metal and mining. As I kind of alluded to earlier, this sector is the valuation approach that we take in this sector is driven by asset-driven valuation, and it has been the investment in this sector is generally using a counter-cyclical approach. and this sector is going through significant correction in terms of EBITDA per ton. We think that the worst is behind us. Balance sheet of large company in that sector are in much better shape as compared to the previous cycle. They have generated very strong cash flows during the previous cycle and repaid a large part of the debt, and the debt is now significantly sustainable. And based on asset-based matrices, valuation look very comfortable in the metal and mining space. So this is again another illustration of how we are as far as valuation is concerned. So our portfolio is almost 25 to 30% discount to the benchmark Nifty 500 as far as price to book as a valuation matrix is concerned. And we are slightly or more or less in line with the average discount that we used to have over the last 5-year basis. Yeah, this is all I have to talk about on Value Opportunity Fund. Just to summarize, we use the sectoral valuation lever to take aggressive sector calls. At a stock level, we follow a barbell approach where we invest both at one end on cyclical stocks and on the other end growth-oriented stocks. Thank you.
Thanks, Amit, for a detailed overview on UTI Value Opportunity Fund. So now we will move on to take some of the frequently asked questions. In fact, some of the questions are already been coming online as well. So, and we will also move on to take more online questions over the next, say, 15-20 minutes. And here is the first question to you, Amit. The question goes like this. How is the investment strategy followed by UTI Value Opportunities Fund different from a traditional multiple-based approach of value investing, and what are its merits over the latter?
I will kind of try to answer this question using a example. If you just compare our intrinsic value-driven approach to like buying an Android device. Now, as you know, Android phone starts from as low as 5,000 to as high as 1 lakh, but the sweet spot somewhere is in the 15 to 50,000 Android range. Similarly, if you use that analogy, we rarely move below as far as stocks is concerned, below the 10,000 range and above the 50,000 range of phones, as far as if you use the analogy of an Android phone. This is akin to kind of avoiding stocks with terminal value risk and very low growth runway when we buy stocks at the value end of the barbell. What leads to this approach is, or why we use this approach is that the mortality risk is very high in pure value-driven approach, especially in case of companies which face terminal value risk or have any balance sheet stress. Also, if we use an intrinsic value approach, the inherent volatility of the portfolio is lower, and hence the risk-adjusted return are typically on a long-term basis better. We also avoid the other end of the valuation, where the stocks are building in very high implied growth, because our valuation-driven, intrinsic value-driven approach also try to avoid these stocks. Our valuation tilt largely comes from investing in operating cash flow generating companies with a stable balance sheet, and the cyclical sectors we typically invest through cyclical downside rather than investing in cheap companies with poor cash flow profile or growth runway. So we are trying to play the cyclical approach rather than the cheap approach of investing if you are looking at the value side of the barbell. Past performance or history has suggested that during significant market sell-off and during sharp drawdown of value as a strategy, our high quality value portfolio has protected the downside materially better than the peers, because our exposure is relatively better ROC profile businesses, because we follow an intrinsic value approach. Even if you look at the standard deviation of the active return, our standard deviation are pretty limited, both on the downside as well as on the upside as compared to the peers, because of use of our intrinsic value approach rather multiple-driven approach to valuation.
Sure, Amit, thanks a lot for that lucid answer. So that helps in terms of understanding the strategy pretty well. So we will move on to the next question. This is a question to you, Vetri. India seems to be better placed today as compared to the rest of the world from both cyclical and structural perspective. How should investors think about investing in this environment? You're on mute.
Yeah, that's an interesting question, Niranjan. And I think it goes back to the heart of how we should think about investing. One is always the economic environment. It's the narrative about the economic environment. But to my mind, more than the narrative and who is placed better or who is placed worse, I think what should really drive investors to think about investing is clearly first valuations, and second, are you investing in businesses or countries where there will be an opportunity for growth in the future? So really what you want to think about in the long game of investing is, are the valuations in my favor? Am I getting margin of safety? And then you wish to combine that, because nobody starts a business, nobody invests without the belief that that business can grow in size, scale, profitability, and generate cash flow over a long period of time. Now, growth is an essential ingredient for you to be able to get that benefit. So I think when you look at India, clearly it's an attractive destination because the cyclical and the structural are supportive of growth over the medium to long term. But really, what really moves the needle for an investor should always be valuations. And on this front, I think the good news at this point of time is that valuations are back in the comfort zone. So to me, the narrative is important because it determines the long-term outcome, but the action of investing should be determined more by valuations, and one should invest today more because the valuations have come back in favor of the long-term investor rather than the narrative.
Sure, Vetri. Thanks for that. We will move on to the third question. Again, this is a question to Amit. How will the recent development in the global banking system impact banks in India? Also, how would this impact the IT sector, given that global BFSI is the single largest client of the Indian IT services industry?
Thanks, Niranjan. The current banking crisis, or if we can call it a crisis, because it appears to have been kind of curtailed as of now, came from liquidity issues in some of the regional bank in US. If you just dial back to 2008 during the global financial crisis, that crisis was led largely by investing in subprime assets. So if you had invested in a subprime asset or lent to a subprime borrower, and the asset value of that mortgage was going down, of that home was going down, as a bank, you had to take some loss if the borrower was defaulting, because the LTVs were very high. Even if you hold that loan book till maturity, it was very unlikely that you will recover the entire value. This time, the crisis is not driven by subprime lending or below par lending. Actually, the crisis which has come out till now is driven by basic ALM mismatch in the portfolio of some of the regional banks in US, where they saw, because of a sharp increase in liquidity, a very supernormal inflows of deposits. They did not have any avenue to invest that deposits. These deposits were invested in largely in AAA US Treasury or in high quality mortgage-backed securities. And as we know, the US interest rate environment moved from 1% on a 10-year, less than 1% as a US Fed rate to almost at 5% now, which led to a sharp increase in the yield of US Treasuries. And as we know, that higher the duration of the fixed income instrument, higher the mark-to-market loss when interest rates move up. Now, some of these banks had almost 60 to 70% of their assets invested in investments, high quality investments, but having a very high duration and very low. They don't have to take any mark-to-market losses if you had a HTM book. And suddenly, when they try to sell off some of these investments because of some of the requirements of depositors, they have to book losses. And as you know, in case of deposits, if every depositor starts pulling out money at the same time and there's a bank run, very few banks can survive that. So it is a very liquidity or ALM driven crisis right now as compared to 2008. There is no asset quality issue in the US banking system as of now. But yeah, the pressure from the liquidity channel will be felt across the board. There is a liquidity issue in some of the US banks, which will end up in some of the risk aversions in terms of lending across the board. You will see some of the Indian banks also tightening standards because of the pressure coming from the liquidity channel. As far as exposure of the Indian IT stocks or IT services, yes, BFSI is a very large part of the revenue pie of Indian IT services companies, ranging from say 20 to 60% of the revenue coming from BFSI, the sector. But thankfully, exposure to the regional bank, which are the epicenter of the crisis, is pretty limited for Indian IT services player. And as of now, large banks in US are actually gaining market share rather than facing any crisis, and they do not seem to have any significant impact from the liquidity crisis in the US banking system. As far as the Europe Bank is concerned, it's a separate matter. There are one or two large IT players who have very high exposure to one or two bank in Europe, but that is again pretty limited to one or two IT services companies. Post Q3, we saw upgrade in the IT space. However, the BFSI slowdown was not expected then. Now we think that the overall deal closure environment may slow down, and we will see some impact of this deal closure getting postponed on the revenue side with a lag. And that impact will depend on what is the exposure of a particular IT services player to that sector and to which geography. So we are watching, but we think that impact will be on a lagged basis.
Sure, Amit. Thanks for the insights. One last question to you, Vetri, before we take more online questions. Consumer spending after seeing a recovery from COVID-19 slowdown, growth seems to be moderated now. So which are the pockets that are likely to see growth slowdown and why?
Yeah. If you look at the recovery that happened after COVID, we have often discussed that it was very much a K-shaped recovery with sort of the mid to higher end of consumer demand and products, brands, categories associated with those kind of consumers doing better, whereas brands, markets, products associated with lower income categories in any case did not see a very strong recovery post COVID-19. I think what we are seeing now is some slowdown, even in that mid to higher end range. Some of this may be an impact of the fact that the sort of demand which had been held back, now it has been fully satiated, and so you're returning to a more normal trajectory. The other issue, I think, without doubt, is that the surge in inflation must have certainly dented household incomes, particularly in the middle, both in the lower middle as well as the middle to higher income groups. And maybe that as well has contributed to growth starting to slow down. So I do think that there is already, in that sense, a growth slowdown which is visible in the middle end of the market. The lower end already had a slowdown, and maybe even in some parts of the high end of the market, we are seeing a slowdown. But it's also the truth that we are moderating now to a spending trajectory which is more in line with where GDP growth estimates also are. I think one of the things we will watch out for in the months ahead is that if India is able to get inflation back under control, hopefully towards the RBI and the MPC's forecast of closer to 5.25%, that itself should automatically start to give consumers some comfort. But at this point of time, I think the middle end of the consumer market, along with the lower end, will continue to see some downside pressures in spending purely because of high inflation and the higher interest rates, which were sort of raised over the last 12 months.
Sure, Vetri. Thanks for that. There is one question on the similar lines, which is on the inflation. So while the world's top central banks are openly contemplating that an early end to their rate hikes, surging oil prices on the back of a surprise OPEC production cut could add fresh inflation pressure. So what's your take on the concerns of financial stability and also clouded growth prospects?
Sure. So I think what's important to remember is what caused OPEC to cut production. OPEC is cutting production in response to the fact that the demand is weak. Now, under that kind of a scenario, the kind of production cut they have announced at best helps to put a floor under the prices. The fact of the matter is that if you look at either Brent oil or you look at the US WTI crude, if you look at where the prices were prior to the Russia-Ukraine conflict and where they are today, they are not vastly different at all. So, to my mind, there is no case at this point of time for surging oil prices. What the OPEC is doing is responding to weakness in demand by saying, let's cut production so that the production is more closely aligned with the demand. So I don't see the cut in OPEC as sort of creating higher inflationary pressures. Sure, if crude prices had continued to collapse, it could have created downward pressures. You will not get that. But I don't see oil at this point of time as adding fuel to the fire, so to speak.
Sure. Thanks, Vetri. There is one question to you, Amit. This is a question on Value Opportunity Fund. From an asset allocation point of view, how much allocation one should be looking at investing in value-oriented funds? And also, how is Value Opportunity Fund is distinct from that of other funds at UTI? So these are the two questions.
Sure. As far as allocation to value segment is concerned, we have said that both value and growth, we cannot predict which one will do better. So an investor should have allocation to both value as a style as well as growth. At what end of the cycle we are in, but over a 7 to 10 year basis, you will see that returns of value as well as growth oriented strategies are kind of similar. On a short to medium term basis, you will see a wide divergence between returns of value and growth as a strategy. So around 20 to 30% of your portfolio you can allocate to a particular fund or a style based on your comfort level. Our value-oriented portfolio is, as you know, we use a score alpha approach to segregate our fund across the UTI fund universe. And we have an approach of classifying the 360 odd companies that we have invested that are part of the universe into R1, R2, R3 groupings, depending on how consistently they generate return on capital employed above the cost of capital. So we have R1, which is above 18% return on capital, and 10 to 18 is R2 and R3. And we have, again, the universe divided between consistently cash flow generating companies and inconsistent cash flow generating companies. So if you look at the UTI universe, most of the funds that we have very strong operating cash flow profile generating companies. Almost all the funds are invested in companies. More than 75% of the investment is in companies which are in the C1 segment, which means that they have consistent cash flow generation over the last 5 years. While if you look at the R1 profile of the funds, you will see a wide divergence, where funds which are largely growth focused will have very high R1 in their portfolio. For example, a flexi cap fund will have almost 85% plus of its investment in R1 kind of stocks, because the fund is focused on quality companies, consistent free cash flow generation, and very high ROC profile. And while some of the value-oriented fund will have a mix of R1, R2, R3, given that they are investing in cyclical companies which generally tend to have relatively less consistent ROC profiles. So, for example, in Value Opportunity Fund, typically 50 to 55% of the investment would be in R1 kind of companies, and almost 40 to 50% of the investment will be in companies which are cyclically challenged and which are expected to come out of the cycle. And maybe on a 5-year basis, they will still remain R2, R3, but on a incremental basis, they are likely to dip on R1 kind of matrices. So that is how Value Opportunity Fund is different from some of the other funds. You have to look at the R1 composition of the fund. And the valuation of the fund, again, our valuation of the fund is, say, 30% cheaper than the benchmark, which is in line with our value strategy. While some of the funds are having growth orientation, will have valuation which is maybe 20 to 30% expensive than the benchmark.
Sure, Amit. Thanks. There is another question on Value Opportunity Fund. In your initial deliberation, you mentioned that the fund has an active share of over 65%. So what does it mean for the investors? And the second question is, how do you mitigate the overall portfolio risk?
So the mitigation of the portfolio risk is already explained through the fact that we use a barbell approach. So the cyclical orientation of the portfolio comes from investing in value-oriented stock, which are going through cyclical issues or cyclical problems. But at the same time, we focus on investing in only those cyclical stocks which are unlikely to have any terminal risk, whether the terminal risk comes from obsolescence or the terminal risk comes from balance sheet related issues. So that eliminates some part of the risk. On the other hand, on high active, as far as high active share is concerned, we have around 65% high active share, and that is largely coming from the fact that we have very high active share in individual stocks, and in case we are not really convinced about a stock, we exit that stock rather than keep a benchmark plus minus benchmark hugging strategy. So we avoid having an underweight exposure to any stocks. We always have an overweight exposure. Now, a specific portfolio company or the position sizing of a company depends on what is the weight of that company in that benchmark. Secondly, it depends on where we are in the cycle in that sector in which the company is operating in. And thirdly, how comfortable we are or how sure we are about the earning trajectory of the company, whether it is improving or deteriorating. So these three factors kind of leads to adjustment or balancing out the position sizing of specific companies. And on the top of that, as we mentioned, a valuation-driven approach at a sector level act as a kind of a guardrail for us to ensure that we are not impacted by a significant specific sector-related headwind and are caught off guard as far as valuation is concerned.
Sure, Amit. Thanks for that. In the interest of time, we will take last two questions for the evening. And this is a question to Vetri. So over the last couple of years, value stocks have a good run up over the growth stocks. How is this likely to play out going forward? And are there any signs of tables to turn around, particularly for funds which are following blend or growth strategy?
Sorry. These cycles are notoriously hard to pick bottoms and peaks. So it's hard to know when the inflection point will come. But as you know, we have sort of, updated some of this data in our presentations. And when we see the outperformance of value versus quality, it appears to have persisted now for a reasonably long period of time. And while there's no science to this, historical trends would suggest that this course has run its way to a large extent. I'll also make the point in a slightly different way, which is that when you look at what has changed in the environment today, it is the fact that there is a certain respect for money which has come back, which is to say that the cost of money has now been set at a reasonable level. Once you have cost of money which has been set at a reasonable level, businesses need to be able to generate a reasonable return on capital to be able to justify their existence. And the whole cycle of reasonable return on capital, reinvestment of cash flow into the business, etc., comes back into play. So I would actually say that the needle is certainly, from a fundamental point of view, pulled back from a point where it was 180 degrees perhaps away from quality to a slightly more neutral position today as compared to where the needle has been in the past. Again, hard to pick the inflection point, but I would say today the market environment and the economic environment in terms of fundamentals, cost of capital, is slightly more balanced outcome today, and that should sort of help the quality growth strategies to pick up some momentum. I'm not sure it has completely shifted in their favor away from value. If cost of capital were to go up much higher, that could happen, but that is not the base case, and which is why I would say that today we are slightly more neutral.
Sure, Vetri. Thanks. There are more questions coming on IT, so I will take one question on the sector. So, how will the in-house AI applications like ChatGPT or its variant would actually impact the performance of Indian IT as a sector in the short and long period?
Sure. Very early days to say that, Niranjan, at this point. I know the companies themselves are seeing how they can use things like ChatGPT, etc., to improve their own internal productivity. Then, of course, clients will look to see how they can use that to improve productivity. To my mind, if I look at the journey of Indian IT going back, more than 25 years, every time there is a cycle, in terms of a change in technology. I remember the early days of the late 90s when it used to be all about implementing Y2K transition for global companies. That was the business model of Indian IT services companies. From there, they moved towards, enterprise solutions. They moved towards implementation of things like SAP. They moved towards running the enterprise, the heart of the enterprise. Then they moved on to remote infrastructure management. They got into more sort of consulting, domain-led business lines. And then, of course, in the recent period, we have seen the driver of IT services growth being the whole cloud, digital, SaaS. So every time there is a change in technology, it has actually proved to be a new wave, maybe with some bit of lag for the IT sector. I don't think that fundamental equation will change, but it is something we will have to be on guard for in terms of the implications it will have. And I'm sure, some of the IT companies have proved time and again that they have managed to ride the technology cycle quite well and pick up a tailwind from the change in technology cycle. Not every company will do it equally well. So to my mind, picking the right company in this environment may perhaps become more and more important. But again, very early days at this point of time. So I don't yet have a judgment of to what extent, I don't have a quantification of to what extent this might actually impact the companies or even prove to be a tailwind to the companies.
Sure. Amit, one question to you. If you can quickly share your take on auto sector. So on the face of heightened inflation, so what is your take on the changing narratives on the demand supply gap for the sector?
Sure, thanks. So auto sector is can be divided into different subsectors like commercial vehicle, passenger vehicle, two-wheeler, and tractor. So from an overall cycle point of view, we think that, or actually, at least in my portfolio, what is reflected is that tractor are at the mature stage of the cycle, so we have no exposure to tractor. And we think that commercial vehicle are also at the mature state of the cycle. while we are more comfortable with two-wheelers and passenger vehicle as far as the cycle is concerned. Impact of interest rate on auto is pretty limited at the current environment. As you know, auto is a fixed rate book. It's a fixed rate book in the sense when companies or banks lend for an auto for buying out passenger vehicle or a two-wheeler, the interest rate don't change by the repo rate change. It's a fixed rate book. So existing borrower do not have to pay a higher EMI because of change in interest rate. However, for an incremental borrower, obviously the rates change. But if you look at, especially for two-wheelers, the absolute change in the EMI for buying on a typical two-wheeler of a 1 lakh rupee doesn't change or doesn't move the needle by 100 or 250 basis point increase in interest rates. So overall, two-wheeler are the least impacted by interest rate change. And one can say that maybe CV are the most impacted by the interest rate change, and passenger vehicle lies somewhere in between. As far as the replacement cycle is concerned, we think that the replacement cycle will play out in favor of both passenger vehicle and to a larger extent in two-wheelers on a cyclical point of view in FY24. Two-wheelers had just come out of a very strong, sharp down cycle, driven again by the pandemic, where we have seen a K-shaped recovery, where the lower part of the K was suffering much more, and which typically caters to the two-wheeler segment. We think that as things normalize in that segment, we will see the typical replacement cycle play out in two-wheelers. On the passenger vehicle side, yes, maybe FY23 has seen a very strong rebound from the FY22 numbers, and maybe FY24 may not see a similar rebound, FY20 similar growth. But again, we still expect growth numbers to be decent in FY24. But we are more confident about the margin outlook of the sector in FY24, both for the two-wheelers and four-wheeler space, given that commodity prices have corrected, and both these, especially the passenger vehicle segment, had suffered because of sharp increase in the commodities, which is a large input cost for the auto sector. So to summarize, confident about margins in two-wheelers and more confident about both volume in two-wheelers, and more confident about both margins and volume in two-wheelers and four-wheelers.
Sure, Amit. Thanks for sharing your views. One last question to you, Vetri. So in the wake of subdued performance by equities for the past few months or a year, so there has been a lackluster performance of actively managed equity funds. Investors tend to rethink on their investment options and churn their portfolios irrationally. So what's your advice for investors on this backdrop?
Well, I think, again, what I will reiterate is the best times to invest are always when the valuations are in your favor. The good news is that valuations have now come back into the comfort zone. So it's worth thinking about why the returns have been lackluster over the past year and a half. Perhaps a lot of it has got to do with the fact that the valuations were rich at that point of time. Yes, it could be disappointing, but I think one of the things we will always have to handhold investors, and at least that's something that we always try to do from our end, is to always reiterate to them two things. One, the benefit of remaining invested for the long term. Equity returns are not like a fixed deposit where they clock in on an annual basis. There are periods where you can be stuck in traffic and the car looks like it's going nowhere, and then suddenly you hit a highway and the speed increases. So average speed means nothing, just like average returns mean nothing, because the returns are not time sliced equally. So that's point number one. Make the investors think long term, understand the variability of returns, and very importantly, remember that returns may be lackluster over the last 18 months, but now you've got valuations which have come back into the comfort zone, and therefore incrementally it does make sense to look at equity. But as we say, in a staggered approach, only because the sort of green light is not fully in as yet in terms of valuations being bargain basement, but certainly within the comfort zone. So that's the distinction we need to always keep in mind while investing in equity.
Sure, Vetri. Thanks a lot for that insight. Yeah, participants, if there are any questions which are missed out taken here in this webinar, so you can get in touch with our relationship managers or UFC. We'll be more than happy to answer your queries. Alternatively, you can also write to us on ask.uti@uti.co.in. So we'll be happy to get back to you on your queries. So with that, back to you, Vetri, for closing remarks.
Sure. First, thank you, Niranjan, very much for hosting this call as always and putting together the presentation as well as collating all the questions as they come in from our viewers. And of course, without our viewers, there would be no point, viewers and listeners, there would be no point in conducting these webinars. It's the questions that you ask, and hopefully this gives us an ability to engage with a much larger audience. Remember that these webinars also go up on our YouTube channel subsequently. So just in case you missed parts of it and you wish to rewind or wish to check in on something we said, it will be available on the YouTube challenge with some time to pass. So thank you once again for joining us on this edition of the Monthly Market Insight, both with me and Amit Premchandani, who manages the Value Opportunities Fund. And I look forward to connecting with you again in the month of May.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.